Can you actually believe this? I am the only one here. Everyone else is late. Everyone. It's only me. So I don't want to hear it. Okay. Tanner's not late. It's literally everyone else. They're not backstage. All right. So go ahead, blow their phones up. They're not waking up. All right. Tevis just said, I'm 10,000% going to be late grabbing a coffee. Okay. Ladies and gentlemen, welcome. We should be getting the earnings report at 7 a.m. So really looking forward to that. I'm not nervous at all. I'm just excited. Okay. There's like such a little chance that we miss on expectations. They're set pretty low. And yet the potential growth in members, very, very high. Members are by far the most forward-looking indicator for SoFi. So if you're talking about potentially hitting 11 million members or something like this, which could happen, we could end up seeing over 872,000 new members. I think Data Driven Investing, who should be on later, said, he should be on now. I don't know where he is. Come over to the Future Investing channel. Don't listen to these guys. These guys are late. They don't respect your time. I'm kidding. That's a little joke. Okay. But if it comes in at 900,000 members, those members are going to need to sign up for products, right? Those products potentially are the easiest forward-looking indicator if they continue to use those checking accounts, pay off their credit cards, Holy David T, relax. We haven't even seen the earnings yet. Thank you, my friend. Really do appreciate that. That will actually allow 50 new members of the Future Investing channel to see this SoFi weekly after hours. Thank you. Thank you, brother. For being on time for once. Thank you, brother. Okay. Yeah, that being said, I'm going to keep an eye out on X to see if we ever see an early release of this report or something like this. But I'll keep an eye out. We don't have anything yet. Spotify just reported. Miss on revenue, miss on monthly active users. They are guiding lower than expected, and they're guiding to see Q2 monthly active users lower than expected by like a lot, like 5 million member miss. So just while we're waiting, there are other companies that are reporting right now. But don't worry, I have SoFi's page up here, and we should be getting the report here in the next minute or so. I'll also be putting X up here to make sure that if Bloomberg Terminal or something like this gets it before us, then we can throw that up very quickly as well. All right. Dude, I'm so excited. If we get like 900,000 new members, Data Driven Investing was right. I'll give up the tag. Congratulations. And yeah, he'll be the winner, but essentially we all will because we're potential shareholders of SoFi. Maybe people are looking at this as a potential way to enter SoFi stock. Remember, this is not just a bank, right? We have a couple things to be looking for. SoFi is a technology platform for other institutions. They're a lending platform for other asset managers. There's going to be a lot of things that could be very exciting to see.
Yo.
What's up, man?
Hey, sorry I'm late.
It was just me.
Who else is supposed to be here?
Data Driven Investing.
Oh, yeah.
Good morning.
6 a.m. wake ups, bro. I hate it so much.
Nah. It's 4 times a year. This is our Super Bowl, okay? Pull it together.
If you say so.
All right, so get your stuff out. It should be coming out any second now.
Yep.
All right, so tell me if you get the numbers. I'm going to continue to refresh all the pages. If anyone in the chat sees it, let us know. And also all for fake numbers. Okay.
Yeah.
Let's keep an eye out here. We're on the investor relations page for SoFi. Currently, actually, let me check SEC filings as well. It might show up there first. Okay. Sip the coffee, brother. It's
Yeah.
okay. You're going to wake up.
Yeah. Eventually.
Yeah. Tevis is struggling.
Yeah, dude.
All right. Nothing so far on Twitter. Not seeing anything there.
Mm-hmm.
SEC filings are clear.
772 million, 71 million net income.
Where are you seeing this?
Beat on StockTwits.
Sorry, what was the revenue you said?
772.
772. I think those would be both would both be beats.
Pretty weak beat.
Yeah. But 71 million in okay, yeah, we got the report.
Like
Here we go.
CPS.
Let's go, ladies and gentlemen. Okay, let's see the highlights. Record, yeah, you're right. Record net revenue, 771 million. That's up 33% year over year. The fastest growth in 5 quarters. It's also because the comps were really good, to be fair. Adjusted EBITDA of 210 million at a 27% adjusted EBITDA margin. That's better than expected. GAAP net income of 71 million, or a 9% GAAP net income margin. Way better than expected. Record adjusted EPS of 6 cents. Cool. Let's see. Financial services and tech platform contributed 407 million of adjusted net revenue, up 66%. They even separated fee-based revenue of 315, up 67%, representing 41% of adjusted net revenue. Tangible book value grew nearly $1 billion year over year. Where is... Oops, sorry. Added a record 800,000 new members and 1.2 million new products. We all knew that was coming, but still great to freaking see. Expanded the loan platform business with over $8 billion in new commitments. We knew it, but it's still so freaking crazy to see. Holy. Strengthened brand awareness. Strong unaided brand awareness continued at 7%. The company completed its inaugural season of TGL presented by SoFi. So they're showing off a nice product roadmap here and what they've been rolling out. Super cool. All the different products that you can get and how SoFi Plus goes across every single one of them. We still need to see that through subscription and how they're going to be rolling that out, but that's still, super beneficial. Not at 11 million members, which, guys, chill. Okay, this is perfectly fine. 802,000 new members, slightly lower than what I anticipated. 825 somewhere in there. But still, we hit the 800,000 mark. Cannot complain there. Okay. Durable growth of 33%. This is showing off the 1 quarter and what they actually anticipate for guidance, which will be exciting. Yeah, okay. Let's see what else. Fee-based revenue is an extremely fast-growing percentage of their total revenue mix. They want to get this to 1.2 million. They're already, more than a quarter of a way through, and Q1 is going to be the lowest out of the next few quarters because SoFi's growth is extremely linear and non-cyclical like that. So that'll be perfectly fine as well. And same with adjusted net revenue. So I think that they are setting up to beat. Adjusted EBITDA margin. I cannot believe it's still growing. Like, this is not actually what they called for this year. They said that they were going to be sort of lowering in their profitability to push for growth. Okay. 6 cents on their way to 25 or 27 to 28 cents of EPS. A lot of Wall Street analysts are still calling for 25 cents, saying that SoFi is going to miss, even though they haven't. Let's see what else here. Financial services revenue doing great. Contribution margin of 49%. Guys, this is way higher than we ever thought that financial services was going to get, and it doesn't seem to be slowing down or plateauing at all. Like, how high is this going to get? Is this going to be as high as lending, which is roughly around 60%? I would love to see that. Loan platform business is still personal loans. Okay, so there's no student loans here yet or something like this, but we'll keep an eye on that. A new chart here. Okay, capital markets activity. Regular loan sales and securitizations help manage the balance sheet. Okay, so this is just showing off what rate they're selling their personal loans at. So 106.2 is huge, by the way. That's super awesome. Yeah, wow. Yeah, so everyone bashes. If you look at this solid black line here, this is what analysts like David Chiavrini or what's the other one? Who's the other guy, Tevis?
Bologna.
Yes. They say that the fair market values for SoFi's loans are just fugazi. They're just made up numbers, doesn't mean anything. And if you actually look, the rate at which they're selling their loans are consistently above their fair market value. Okay, so how made up is it? Absolutely love that chart. That's going to be one going into the presentations next time. Lending contribution at 58%. That could do better, but we're all right with that.
That's obviously going to fall as a loan platform business, right?
Not necessarily, because it wouldn't even contribute. It would be.
It's not as a revenue mix.
Yeah. But that's also why you could see potential slowdowns in growth for actual lending. Is if they're pushing fee-based, you're actually going to see stagnation or even slowing in lending segments if they start to push everything through the loan platform business. Like Anthony Noto said, they want to eventually get the loan platform business to every single segment of the lending business. Well, what's going to happen to lending? It's essentially they want it to go to zero. Now that's not going to happen anytime soon. But
tech platform, I swear to
God. What did the tech platform get? They're not even showing a chart on it. Oh, right, yes, they are. Yeah. Flat quarter over quarter, decreasing margins. Yep. I mean, we knew it. That wasn't going to be much. Personal loan performance is doing even better. That's awesome.
Holy, accounts actually fell. What?
Fell by 10 million. That's a large account drop then.
Yeah.
I'll have to do some deep diving to find out what company that was.
Wow, that's not great.
Yeah. But also, it's making up for such a small amount of this company. Like I'm telling you, the future of this company is loan platform. Sure. It's not Galileo. Did you see the Devin Ryan report that I put out?
No.
The Devin Ryan report essentially even showed off like the total addressable market for the tech platform is not like what the loan platform business or any of these things are. Like, it's actually much smaller than people give it credit for. You can't just continuously add new accounts on like it's free. Total risk-based capital ratio is at 15.5%. That's actually down. So they're getting a little bit more aggressive, which is interesting in this environment. Net interest margin of 6%. Cool. Funding base at the highest it's been at 90%. Fully deposit growth. Wow. Okay, so did they raise guidance? Yes, yeah, they did. They raised EBITDA. They raised net income. They raised full year 2025 guidance for EPS.
Mm-hmm.
Tangible book, it's across the board a raise on guidance.
Yeah.
That's it, baby. Let's see what we're expecting next quarter. A ramp in net revenue. Not really a ramp in EBITDA, not really a ramp in net income. So they think that they want to grow revenue at 31 to 35% year over year growth. Guys,
Well,
what bank does that? I'm like, okay, cool. Tech platform adjusted net revenue growth of low double digits to teens is what they're expecting for business segments here. I don't know if you guys can see that. Maybe we can make it bigger here. Let's here, 1 second. Okay. Let's go through this really quickly. This is important. Lending adjusted net revenue growth of low double digits to teens, which is the same as the tech platform. This is for the remaining 3 quarters of 2025. And financial services adjusted net revenue growth of 60 to 65%. Asset growth of single digit billions. All right. What were your first thoughts?
meh. I mean, the EPS is nice. The
Why
percentage
does it
of
look like
revenue
that?
mix for fee-based is nice. The tech platform is kind of crap. But what else did I find? Yeah,
Did you
like
expect it to not be crap?
I mean, I don't know, man. I keep getting let down by a tech platform. I was kind of hoping it wouldn't be crap, but I'm not really surprised that it is.
Man, they said all the recent deals. Okay, so here's a couple interesting things with the tech platform. They're still expecting double digit to teens percentages of growth. Why could they potentially be holding that level of growth if they're losing big clients?
Sorry, repeat that one more time.
Let's go down.
I was reading comments.
There's 3 quarters left. Okay.
Yeah.
And we've already seen April. So we have 8 quarters to go.
Already seen April in terms of what?
They know the numbers internally.
Yes. In terms of guidance.
Right. Tech platform adjusted net revenue growth of low double digits to teens. So are we going to stay stagnant or declining, or are we expected to close deals that is still going to push that growth?
Well, it's at
forward?
10%. It's at 10% growth now. So I'm assuming they're baking in a small ramp.
Yeah, but I'm just saying to be worried about this sell-off. And plus, yeah. No, I see what you're saying, but that's on top of full year 2024.
Yeah. So for next quarter, they said teens or low double digits.
No, for full year. So all I'm saying is this 103 consistency that we've gotten in the last 3 quarters, I do not think that is what they're expecting for the next 3 quarters, is all I'm saying.
Yeah, but not necessarily it's going to come next quarter. That it could be towards the back half of the year.
Is the stock running? Is this what people are telling me?
The stock is up 2%.
All right.
Hardly running, I would say, but it's up.
SoFi.
Where's Chris at?
I don't know. You probably have some dumb excuse like he's taking care of his kids or something.
Ugh, I hate it when he uses that excuse.
Yeah. Okay, let's go through some originations and everything. Record high total originations. That's crazy. Here, can I bring this up? So until I actually plug these into my spreadsheet and everything, which I'll do during the earnings call, and then we can do all that.
Mm-hmm.
We have record levels of originations at 7.2 billion. 5.5 of that was personal loans. Sorry, my camera's blocking it.
Noto's on CNBC right now.
Throw it up.
I mean, I don't have it up, But
Okay, I can get it. I can get it. 1 second. Man is bright and early, eh? Okay, CNBC. Well, I look for this. Tell me some of your other thoughts.
oh, they're bringing back crypto.
They said that?
Yeah,
All right.
that's cool.
Yeah, he's live.
Yeah, throw it up.
It's been really positive. We want to be able to offer blockchain products and crypto products across every area that we're currently in. So across lending, across paying, across investing, and as well as protecting. We think it's a technology more than anything else, and we can use it to allow people to pay easier at lower cost, to pay faster, and over time be able to capture some of the opportunity by providing infrastructure services to third parties via our technology platform. So it really will cut across every element of our business.
What is the blockchain business and crypto business in the lending space ultimately look like to you?
Again, it's going to be subject to the regulatory environment, so I just have to caveat that. But today, we provide margin loans in our invest business where you can borrow money against your securities, against your assets. We could do the same thing with cryptocurrency. If we custody the cryptocurrency, we can provide a secured loan against that currency. Again, a lower cost of lending for our members, just like margin loans are, but an asset that they can borrow against, just as they do their home or securities in their invest account.
Right. So there's two things going on that I know some investors may have some confusion about. So there seems to be an effort at one level to move away from the sort of classic lending business to focus more on fee revenue. At the same time, there's been a huge growth in the lending or loan platform business. And so can you explain the distinction for those who are sort of trying to follow this company?
Sure. The first thing is to understand our mission. And our mission is to help people reach financial independence, to realize their ambitions, which means they get to the point that they have enough money to live their dreams, their American dream, have the size family they want, the size home they want, the career they want, and live where they want and retire when they want. In order to do that, we have to be there for every one of their major financial decisions in their lives and the days in between, which mean we really have to be across everything they do: borrow, save, spend, invest, and protect. So we do have 4 great loans. We try to provide the fastest place to apply and the lowest interest rates. We have more demand for our loans than we can fulfill ourselves. So some portion we'll do ourselves and some portion we'll do on behalf of third party. So the loan platform business is really a fee-based business where we leverage our origination platform, our marketing platform, our servicing platform to underwrite loans for other people like Blue Owl and Fortress.
Well, that's what I was going to say. So you did this, explain though, because I don't know if everyone knows, you did this deal with Blue Owl, which is one of the big credit providers in the country, for worth about $5 billion, right? How does that work?
Yeah, the way it works is they contract with us for a specific type of credit they want underwritten. We go out and generate demand for that underlying loan. We then fulfill that loan, and they take the loan away from us within a couple of days. So it's very capital light. We don't retain any credit risk, and we don't retain any capital requirements. It's something that we're doing on their behalf that we would not otherwise do for ourselves, either because we don't want that level of volume or that credit box. We actually turned down in a year over $100 billion of loan volume. We only fulfill about $20 billion ourselves. So that over $100 billion of loan volume, other people would like to have. We focus on a high-end customer that's 680 and higher, average FICO score around 750, average income around $150,000. But there are many of other people that have the need to invest in assets at a lower credit spectrum, and we're helping them do that in addition to some volume in our credit box that's above and beyond the volume we want to do. So it's a high margin revenue stream, it's fee-based, and it doesn't retain credit.
What do you see in terms of the strength of the consumer? And I ask because there was a piece, I think, in the Wall Street Journal just this week, right, about so many people using buy now, pay later, and just putting more and more things on their credit card. You're starting to see a credit build. There's a Lending Tree survey finding Americans are using more of these services than ever before just for groceries and things, Anthony.
Sure. We're watching all the macroeconomic factors the way we would any other time of the cycle to make sure we have our early warning if there are problems. So far, we've not seen any issues with credit. In fact, our credit performance continues to improve. Our 90-day delinquencies improved again for the 5th quarter since last year in a row. We've also seen lower than expected net charge-offs and an improvement there as well. So the underlying credit's doing well, and the demand for loans are very strong. We're also seeing strong spending in our SoFi Money business. We're annualized at about $14 billion of debit spending now, and it's growing faster than our underlying member growth there, which is about 46% growth in our money product, and spending is growing even faster. Deposits are growing faster as well at 52%. And then in our invest business, where you can buy, sell single stocks or fractional shares, IPOs, alternative assets, we had our strongest engagement quarter ever, even stronger than when we launched crypto or IPOs or alternative assets. And so an acceleration in our member growth there, up 21%. And we expect that acceleration to continue throughout the rest of the year. So we guided the full year up in addition to beating. We also guided 2nd quarter above consensus. We feel great about where the business is. We're looking for all the data points everyone else is talking about, but so far things have been pretty strong.
Anthony, do you think that's because it's a reflection of your members, a reflection of your clientele, or do you think that maybe some of those stories are being exaggerated about people needing to borrow to pay for the groceries?
I think it's a little bit of both. We definitely have a higher end customer, and the viewers should understand that. We're going after a high income customer, $150,000 income or higher, high credit, 680 or higher. So that's in our loan business, but our money business goes after everyone, and our invest business goes after everyone. So it is a reflection of the broader economy. I do think people are looking for reasons not to be bullish here because of the uncertainty. And believe me, I know how to be as bearish as anybody. And right now, we're not seeing the changes. What would scare me is if we had unemployment get up into the high 5 or 6% range. We're not anywhere close to that today. But in an environment where we have declining rates, we're going to do incredibly well. We're going to see a lot more home refinancing. We're going to see refinancing of student loans, and we're also going to see continued improvement in credit in that environment, as long as we don't go into a deep recession or have some type of liquidity dislocation. A deep recession, liquidity dislocation would be really bad. But right now, it seems like things are being managed pretty well.
Anthony, great to see you, sir. Hope to see you in person soon. Congratulations on the results.
Thank you.
A lot more to come. Thank you.
Thank you.
Dude, I think you'd be crazy picky to think that this was anything but a strong quarter. But without further ado, let's get the insights from Data-Driven Investing, who was super late, and it wasn't it wasn't me. It was him.
Can you guys hear me?
Yes.
Okay. Okay. So I woke up and it was 5:05, and I went, oh crap. So apparently my alarm didn't work. So sorry, guys. I am just barely digesting the results. So I don't have a room where I can do this at home. So I very quickly flew to work in my Tesla, and was afraid I was going to get pulled over, but didn't. And anyway, I'm just digesting them now. The headline numbers look great. I haven't looked at the one thing. It was, what was the tech platform like?
Don't look at that. Don't look at that.
Okay, so it was basically flat.
The members are down 10 million.
Down 10 million in new member ads?
No. Total is down 10 million. We went from 168 to 158.
That was my reaction too.
Lost a big customer for sure.
Oh, in the tech platform. I thought you meant like SoFi members, and I was like really confused there for a second.
Yeah, we only have 800,000 members now.
Okay. So yeah, the tech platform again continues to be what it is.
I think this was the first time he went on CNBC before the actual call.
Yeah, maybe. Maybe he's got a lot of calls lined up. Ladies and gentlemen, please welcome Anthony Noto. No, I'm kidding. I'm so sorry. I shouldn't have done it.
But the bottom line looks really good. Like the 6 cents of EPS.
Yeah.
Yeah.
And the margins going up.
And guidance.
Yeah, and guidance, they're just like, I haven't looked at guidance yet. I don't know. It looks like a really, really strong quarter, including what was Q2's guidance look like? Sorry, I'm flipping through the slides.
Page 24.
785 to 805. Actually, that's pretty good. That's above the analyst estimates. Like, I don't know, again, with the exception of the tech platform, which we've been through, right? Like, this looks really, really strong.
Yeah, yeah.
Across the board.
Yeah, if you annualize, like I actually like what they show off here. If you annualize what they've done, we are already looking at, smashing growth on revenue, fee-based revenue, across the platforms. But it's not going to be flat. Like,
Yeah, exactly.
so, this whole looking at guidance as how we see it. Guys, if you're new to SoFi, this is going to happen for the next 3 quarters. They're going to beat and then raise guidance going forward. And so this whole idea that we're going to get 24 to 27% growth, I'm not believing it still. They're going to adjust it to 25 to 28 and then 29 to 30. Like, that's just what happens. So who knows?
Just them putting that annualized number out there almost serves as a floor, because otherwise, why would they put it on there? Because people are going to anchor to that annualized number, right?
Well, I hope they anchor to guidance, but yeah.
Come on, let's be real, dude. Like, you see that bar
It's true.
with a dotted line, like that's what people are going to anchor as the full year, and so they probably are I would imagine they're expecting internally to come in even above that dotted line. Otherwise, why would you put that dotted line on there if you don't think you're going to hit that?
Right.
Like
Yeah.
if Q1 is out of the ordinary and you're just giving them an annualized chart to look good, you're screwing yourself over in future quarters, right?
Yeah, exactly. And you could see here in the blue what their each individual Q1 numbers had looked like comparatively to the rest of the year.
Mm-hmm.
Yeah, I mean, revenue's up 32, 33% year over year. Like, again, most companies would die for a 30% revenue growth rate. That's really impressive numbers.
Yeah, but we saw, good member growth. Not 900,000.
No, not 900,000. I was wrong.
But still extremely good. And we definitely are past 11 million. That is still the case.
By now, for sure.
Yeah. It's just a matter of including April as well. Members compounded annual growth rate of 52%, products at 54%. So I need to look at this, but just looking at year over year growth of 35% with members at 34%, that's a better attach rate than what we've seen.
Oh, that's true. It's probably because of the loan platform business. Have they said, or do they say somewhere in the slides or in the press release how many of the originations were LPB?
Yes. Yeah. You can find that right here. 1.5.
Oh, there it is. Okay.
1.56 billion this quarter.
It'll be interesting. I hope that they talk about when the LPB deal with Blue Owl started in the quarter, because we've got like a certain number of originations that we know are going to happen because they've announced the deals. It'd be interesting to see like how much of these are on top of that are unannounced, if that makes sense.
Yeah, absolutely.
Because last quarter, I think it was 1.1 billion, and we still had the same number, but 1.1 again to 1.56 billion. That's a lot, right? Like, I don't know. That business is just money. And the other thing is, I think it allows them to do marketing in ways that are both responsible in the near term, but have really high ROI. Because your highest ROI customers that you're going to ever have for SoFi are the people who are going to be taking loans. Mm-hmm. And this allows them to get an immediate payback on that marketing spend, if that makes sense. So like, so their average loan as of like 2023 personal loan was like $33,000. And if you take that and you multiply it by like the take rate that SoFi typically gets from an LPB deal, they're making like $1,400 every single time they sell one of these loans on average, right? It might not be that number, but that means that like if they spend $1,000 acquiring this customer, they immediately made $400 on day one. And now everything else for all the future of that member's entire life is gravy. right?
Yeah.
And so that allows you to go out and spend a lot on marketing and not have to and get immediate return on that money, and then you get that person into the ecosystem, which I think is probably one of the reasons that that since they've implemented the LPB, they're able to boost their marketing spend, but then get immediate ROI on it. So, like, I haven't looked at, again, I'm just getting through this for the first time, but those have kind of been some of my thoughts, and that's what it's looking like here, right? Like, the more they shift there, the more they're able to get immediate ROI that they're not particularly concerned about losing.
Out of the 3 companies that I was looking at this quarter, SoFi is up 4.4% right now, ladies and gentlemen, in the after hours. Essentially $13.78. Shift4, not many.
In the pre-market.
Yep, not a lot of volume here, as you can tell by the lack of bars. Up 5.76%, and PayPal down 2.2%. Don't let that, make up your mind, because SoFi has been very positive in pre-market numbers, and then it opens into institutions dumping all over the stock. So we'll have to wait for Wall Street to make,
I saw people commenting. They were like, "Oh my gosh, it's up finally!" And I was like, keep waiting." We've been through this cycle a bunch of times.
It's hitting new highs though, 1383 now. It keeps pushing. So unless you guys want to show something for the stock price, why don't we just keep this up here for a minute, and we can be degenerates on 1-minute charts following.
There you go. I mean, I think it probably deserves to be green today, right? Based on those results, when you beat by
definitely
like $40 million on the top line, you beat by 3 cents, which is $30 million on the bottom line. That means that so again, last quarter they were like, "Hey, we're going to reinvest for growth." It means that the adjusted EBITDA is only going to be up, 30% is going to be our incremental margins. Once again, they killed that, right? Like they dropped a lot more to the bottom line than they said they would.
Yeah. So
did you guys hear about this deal with the Panama Bank?
No, I didn't hear anything.
Mercantil Banco.
No.
Is it in the slides or the press release? Probably the press release. That's where they.
Oh, I didn't even read the press.
Right?
Yeah. For the tech platform.
More LATAM.
Mm-hmm.
All right. Let's take a read.
It's just one sentence, but it's interesting.
We are off to a tremendous start in 2025. I'm just going to read this because we haven't covered this yet. We delivered durable growth and strong returns driven by our relentless focus on product innovation and brand building, said Anthony Noto, CEO of SoFi. Handsome. We delivered our highest revenue growth in 5 quarters, driven by new records in... Sorry, I looked down and I saw Chris kind of giggling. Lost my whole train. Driven by new records in members, products, fee-based revenue. They're really pushing that. That's a top 3 KPI for them now.
Dude, Anthony Norris is going to read this in like 20 minutes. So this is like literally word for word the opening remarks. I don't know why you're reading it.
Okay, guys, you guys come to this channel for news that's 27 minutes early. These results demonstrate the strength of SoFi's unique strategy, combination of businesses, and product architecture, which gives us a sustained competitive advantage with the highest lifetime value per member. This allows us to innovate unmatched products and services to help members spend less than they make and invest the rest so then they can make their money right and realize their ambitions. With strong momentum in the first quarter, we are both accelerating our rate of innovation and increasing our financial guidance for 2025.
Dude, just put the stock price back up. It's up to 6% now. That's what's going to get.
That's what people want to see.
Let's go. Let's pump. Sorry, my bad, guys.
I did think so. I was listening in as I was driving.
14.
The one thing that I actually really was excited about from that CNBC interview was that he talked about like crypto-backed lending and that sort of stuff, like asset-backed lending on crypto. That's something that I don't think, like, I don't know if I don't use Coinbase. Can you do that on Coinbase?
You used to, and then they took it down. Regulators
So-
took it down.
It's something that I don't think. Again, he said pending regulation and whatever and whatnot. But the fact that they can offer that
To the
is a
moon!
unique part of the is a unique part of the lending business, right? That is a unique thing that SoFi can do that maybe not other competitors like Robinhood and Coinbase can, maybe for regulatory reasons, but also that like they don't have the ability to do it quite as much. Oh, what the heck happened to HIMS?
They just partnered with Novo.
Sorry, they're the second one in my list, and all of a sudden they just disappeared.
they just
Or
partnered
they
with
just
No.
Anyway, sorry.
Man, that's great.
We can go back to SoFi, but
Still good.
yeah,
Still good.
it's
Up
still
7.
going.
Up
I
7.
wonder why are these candles coming now? Did they secondarily announce earnings?
Dude, look at SoFi's chart though. They look like they've been taking HIMS. All right, let's continue. You were
What
saying
do you
something
think-
about the financials there, Chris?
I wasn't.
Did I
at the
lose you?
time, but I can. No. Can you hear me?
Yeah, no, you're good. Sorry, my bad.
No, I'm just saying that I think that they can do unique things with lending in the crypto space that won't be matched other places.
Yeah, I have no idea what you said. Sorry.
Tevis, did you know what I said?
I wasn't listening. Bro.
Yeah, there's not a chance.
I was making a HIMS post. I'm sorry, Chris. Repeat that one more time. They have a chance
No.
somewhere.
I think on the crypto space, what
Mm-hmm.
Anthony Noto was talking about lending inside of the crypto space, I think that that's something that's unique to that SoFi can make unique offerings on that maybe others without a bank charter might not be able to.
Yeah, for sure.
I was excited during the interview that he talked about that. I haven't seen it in the press release. or anything.
Crypto-backed loans is what you're talking about?
Yep.
Yeah. I mean, he flat out mentioned that in the Q4 earnings call, saying that we, can see us expanding even further than the brokerage services on crypto, where you're essentially doing asset-backed lending with your cryptocurrency. Holy HIMS, 22%.
That's not as cool as I actually prefer 5.7%, but like steady and like
New partnership with the Country Music Association Fest. Nice.
Oh, we knew about that.
Yeah, we knew
announced
that. Yeah. Tevis has a real day job. He's not
I'm getting these news like late.
Yeah, you're getting it in the press release. Literally.
I'm a real analyst now.
He missed the first press release, so he's not even getting it in the press release.
Yeah, that's true. Yeah, they did like a straight. Yeah, it's true. It's on SoFi's like newsroom page.
Yeah, I see Matt Money in the chat who's giving me crap for not being 25. Matt, I will let you buy out of your bet for 250. You don't have to go through for the full year for the full 500. 250 you can buy out now. Take it or leave
It's a
it.
good deal. Among SoFi Plus subscribers who are completely new to SoFi, over 75% adopt at least a second product, and over 40% adopt a third product within 30 days of enrollment.
That's way faster than it used to be.
Over 40%. Yeah, it used to be 50%, right? 50% would get a second product.
50% would get a second product. That means
Yeah.
the cross sell is accelerating.
Over 75% adopt a second product, and over 40% adopt a third product within 30 days of enrollment.
They must be doing something differently, right? Like that's a huge delta on where it used to be.
What's members to product ratio this time around? It should be going up.
I haven't plugged numbers, but I will right now. While you guys have a great and captive conversation with each other.
Just kidding.
You guys are doing great.
We're doing great so far. I was calculating. I'm just doing the products over members real quick because I know that you're typing it into a spreadsheet. That's
yes.
But yeah, it's 1.46 again. So it actually hasn't moved much.
Can you go one decimal further?
1.458.
That's higher.
What was it last time? 1.456.
You're so easily impressed.
There you go.
4,
Well,
5,
the
6.
thing is that it's either been flat or down since like 2022.
It went from like 1.456 to 1.458. It's pretty freaking flat. I don't. I don't know how you can say that's higher. Yes, like on paper that's higher, but in
Petition to kick Tevis. Like, what's going on here?
Man, you need somebody to keep you guys in check. Otherwise, the head balloons, and you're like, this is the best earnings in the world, and then the stock tanks. And
No, we
like,
don't.
What the hell?
We don't need any of
We're
that.
okay with the stock.
It's
Here's the
what's
thing:
happening
like, if the
in-
stock tanks, is anyone surprised at this point? I don't think so.
Half of the people viewing.
Half
I
of the
think it would
people.
be.
Okay, so for those half of the people who are viewing and expect that stocks
Literally-
only go up, especially SoFi on or earnings,
Guys,
typically, go ahead.
If you watch our live stream, you can find where Tevis has been talking. He was talking here. He talked here, and he's been talking here.
Oh man, if I had that power to move that stuff, again, it's a positive sign. But I think the best thing about this earnings was the loan platform business acceleration, the rate of growth that they're providing for the loan platform business. I think things that I wasn't like super crazy about. Tech
Tevis
platform.
talking again?
Look at what he's doing. No, go ahead, Tevis.
I'm not going to say anything, and we'll
No,
let it
go
up,
ahead.
and we'll be happy.
Yeah, we are happy it's going on. All right. Jeez.
So, yeah,
The
I
call
don't
is
know.
going to
Like,
be in 18 minutes, guys.
this looks really good. Again, with the exception, you look at even the gain on sale margin they're getting on their loans is now 106.2%. Like that, like again, lots of bears talk about the fair value
not
marks,
people.
and they talk about all these things. Well, they are people, right?
There's our
Not
people
people
too,
inside of
Chris.
the bears are people too. Not people inside the SoFi community, right? But a lot of the
Scum.
criticism that you see, there you go, about SoFi is about fair value marks. It's about their loans not performing. It's about all these things that we just don't see in the numbers. I mean, the delinquencies are down for the 5th consecutive quarter, right? Delinquencies are a leading indicator of defaults. They might stabilize around this region, but when they just come down over and over and over again, like at some point you got to realize that this isn't some sort of bag of goods that SoFi is trying to sell people, right? Like the results continually back up what they're saying.
SoFi invested great, just so everyone's aware. 160,000 new ads. We haven't seen that in holy crap. We haven't seen that since Q1 of 2022.
Oh, it's been a while.
We haven't seen what SoFi Invest do well since 2022.
160,000 new ads, new customers.
So the attach rate there must be higher, I would guess, is probably something that they're trying to push.
Yep, credit
If
cards
they
is when's the last time we saw credit card? I think this was a record amount of new credit card ads for SoFi. It is. This is the highest amount of new credit cards we've ever seen.
So they're leaning in there too.
26,750. Yep. Wow. Yeah, no, but I appreciate your commentary on the worms, the bears, the scum.
If anyone can't say that, it's probably you who have had them on your channel. I'd imagine you'd be the most neutral of us and like the adult in the room.
I bring them on to make fun of them. We laugh as a community. No, I'm kidding. I respect everyone in the investment community.
Even the worms.
Even the worms. Yeah. The scum.
It's just like, I don't know. We're talking about those people, right? They say when SoFi reaches for growth, right? When you reach for growth in the banking business, what you end up with is you end up with higher risk. You haven't seen it. Like, growth is a red flag. Haven't seen it. The fair value marks are going to collapse. The sales keep getting higher and higher in terms of both, like, in number and in execution level. Like, I don't know. Like, the one remaining bear case that, like, has some real legs to it is the tech platform. But if you're growing the entire business as a whole over 30% year over year, and you're compounding at that rate, then, you know, so if the tech platform were growing, say, 20% year over year, 25% year over year, this stock would be way, way higher. Like, no doubt about it. But at the same time, like, in the long term, I'm not particularly concerned about it because I trust that they're doing good things with it, and it's allowing them to get the growth that they are getting on their own, like on the SoFi side.
Yeah.
And so the growth that they're hitting now, they wouldn't be hitting if they hadn't brought the tech platform in-house and they weren't as flexible and able to offer things on their own.
Yeah. It's not easily seen that way, but it is the truth. Like,
Dude, including loan platform business, SoFi originated a record $7.2 billion in loans in the quarter. What did they do for full year 2024?
I mean, more than that, but yeah.
Well, obviously more than that, but like, it's just one quarter.
Yeah. Yeah.
Q1. It's insane. Like, it's insane. The like, I'm just reading through the highlights. It's crazy that how big the loan platform business is already, considering how new it is and will be.
Dude,
Like,
next quarter could literally be like double the size for loan platform. It's overlapping every deal that they've had. It's both fortress deals.
yeah, do we know that though, Tanner?
They're going to talk about. So Tanner, I'm not sure if you saw this part on the Not SoFi Weekly report.
Is
The No Tanner podcast?
The No Tanner podcast. That's the one that we were talking about.
Mhm.
So
Go
I
ahead.
actually asked investor relations about it.
yes.
About that. I said, hey, I assumed that the 2 billion was just a continuation that'll kick off in Q3 when the other deal ends. And investor relations said that's a reasonable assumption. I just pulled up the email, and he said we will comment on this on Tuesday's call as well. So that we'll hear about it in the call. But it sounds like it's just, I don't think there's an overlap of the two different $2 billion bills. I think it's sequential. I think it's just a continuation, an extension. But we'll see.
All right. Either way, 2 billion of committed capital. Still happy.
Yeah, what I'm saying
and that's
is
a big. Go ahead, Travis.
it's not going to stack. You know, it would be cool if it stacks. The quarterly numbers would be much more attractive in the next couple of quarters. But this way, I mean, you're just going to keep it going for longer. So,
Well, it would only stack for Q2, but if at least the way that I did it, but still, that's fine. It's fine if you guys want to, ruin my party.
Sorry for raining on your parade.
hey,
Yeah.
at least members to products is up like a decimal of a decimal of a decimal.
0.002.
Yeah.
Here,
Dude, it's
if
been
you
going
share-
down though. I did, excuse me for celebrating.
If you share this, so this is what I'm talking about with the loans, right? Like, this is they closed 3.1 billion total, including LPB, but that means that they closed around 1.5 billion of personal and home loan sales in the quarter, right? Like, not including LPB. The marks, like, tell me this isn't a graph with higher highs and higher lows, right? Like, their execution of these sales is at higher and higher percentages over time. And then we talked about the securitization previously, but then when you look at, like, the credit performance, right? So here's net charge-offs. There's this top one. These are, like, this is with the delinquent loans, but even without the delinquent loans, they're just coming down over time. Even the student loans, everybody was freaking out because we got all these announcements about how like what it was, like 25% of all student borrowers are delinquent on their loans, and people were like, this is so bad for SoFi, just because they don't understand that SoFi's borrowers have been paying back their loans the entire time, right? But that's actually a really big drop from 0.62 to 0.47 on their student loan portfolio. Like the charge-off rates are so low, and the fact that they are keeping those loans, which I'm not like, I do wish that they would sell a lot more of the student loans, I think, instead of keeping them, just because the APR the APR isn't as high. But I don't run the business, so you can't, it is what it is. And then the delta between these two curves so if you haven't seen these before, the last time they had kind of high delinquencies between the 7 and 8% range was way back in like 2017. And so the purple numbers, or the purple curve, is how their current loan portfolio is performing compared to the last time that they had these really high default numbers, and they're just under it. So they keep saying, hey, we want to hit between 7 and 8% lifetime loan default rate. Right now, they're over a almost a percentage and a half. Right now, they're trending towards somewhere around 6% of a net charge-off loss, or a lifetime loss of loans rate, which is like better than their guidance for this. So I just don't see, on the credit side, every piece of data you look at is trending in the exact right direction. I know that in a recession that might not continue, but for even in a recession, you still have this really, really large delta between current performance and where they want to be. In the worst case scenario, that everything looks so good on that side. Again, the exception being the tech platform.
Right. Yeah. Also, they showed off how many accounts they churned off the platform this quarter. 13.5 thousand.
Last quarter it was 30,000. So
yeah,
that number, and a couple quarters ago it was like 100,000. So
that's total members. No,
that's the fraud. So those are essentially people that they find who are committing fraud, right? Like, and they take them off the platform. So,
well, I don't think it has to be fraud,
or who asked to be removed or die or whatever else.
It's going to be really interesting to see what analysts choose to focus on the call, because we know we're going to get way more loan platform business details, and probably we're going to get more crypto details, seeing as Noto just mentioned, preempted that on the call. We're probably going to get a press release around crypto, after the call today. And I'm just thinking back to all the members that we lost after losing crypto, and we had to send them over to, was it
blockchain.com?
Chris is one of them.
Yeah, I am.
And we would presumably be getting, a surge of members back. The invest segment would look much better in terms of the growth rate. So I'm really interested to see, exactly how they plan on bringing crypto back, and to what degree, and what they're going to do about regulators. Because they're still not 1,000% green picture from a regulatory perspective. So it's going to be
know, man. I think Roy's been on that for a while. They're hiring like madmen.
They are, but is all regulatory hurdles cleared? Can you say that beyond a reasonable doubt?
We'll hear about it in the call. That's the thing.
Exactly.
Right?
Exactly.
Yeah.
But they wouldn't be hiring this much if they didn't have a green light, I don't think, or an indication of a green light.
Chris, HIMS is up 44%, 45%.
Oh my gosh.
So
look at us.
There was weird options activity on HIMS yesterday. Really weird.
Well, this is why.
This is why somebody knew.
And Roy abandoned us to do his PayPal stream. How's it going over there, Roy? Should have sold it whenever I sold it.
Jeez. Is it down?
Down 3%.
That's could have been worse, I guess.
I don't know. I'm going to check out the numbers. I might even get back in. But yeah. In terms of companies that are growing and consistently adding new members and getting more profitable, this was the right stream for sure. Here, let me make sure that we have the cast. Okay. I'm ready on the call whenever they start it in 5 minutes. Until then, we can go over some more of the numbers here. So let's talk individual products really quickly. Is that sounds nerdy enough, right?
I hope people know that since my eating on the podcast was so well received last night, I will be bringing it back and having a farmer's wrap the moment the call starts. So that's how I'm enjoying the SoFi earnings triple B.
Tim's?
Yeah.
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 The Chipotle mayo, it's there.
I got it. I mean, it wakes you up, man. I got to give the people what they want. They were like, I had a poke bowl last night, and they were like, "We want more of this." And yes, I will have a farmer's wrap this time around, guys. So I'll rate it, do ASMR, whatever you guys want. I'm pivoting the channel.
Yeah. Referred loans actually came in really high. I thought that referred loans was going to start slowing down because obviously the loan platform business can now handle a larger credit box. However, because it's so new, I bet most of these credit providers are coming to SoFi for the credit box that they know that they're really good at underwriting. So,
and I also bet that it's because their marketing spend probably through those channels is going up, right? Because they can originate more.
Sure. So that increased quarter over quarter by 20%.
What would even be a refer, like just outside their credit box? Because it's not loan platform.
To Pagaya.
Yeah. Okay.
Pagaya and other partners, right, through Lantern.
Yeah. So mainly, like B-list lending or like higher credit, or sorry, higher risk credit. Invest went up by 160,000 accounts. It's only up 6.3% quarter over quarter, but actually grew.
That's a high annualized growth rate, though.
Yes. Yeah. It also grew as the percentage of new accounts was the highest it's been in a while at 13.6% of all new accounts was invest. SoFi Money's still doing great, 382,000 new accounts. It's not 500,000 like we saw in Q1 of last year, but still great. Student loans did well. Home loans did well. Personal loans, 101,000 new loans, like just crazy numbers. If you were to look at this, a year ago or 2 years ago, no one would ever have thought that. Yeah. All right. Let me make sure that we have the call, ladies and gentlemen. Anthony Noto, Chris Lapointe, who is data-driven investing, by the way. That's Chris Lapointe. He'll be jumping off this call and jumping onto the earnings call.
I'll just stop my camera so you can't see me talking.
Yeah, he'll just mute. Really appreciate you being here with us and sharing all that insider information.
Just don't say that, kid.
Let's see what else.
All right, call starting in a minute.
Anything else that you guys see that you want to talk about before we see the earnings call? What to listen for? Anything?
I'm excited for the crypto and the other stuff, right? Like we know. I want to hear if they've got like Cash Coach. Like I that's the stuff that I'm excited for, is things that are not here that I know that they're working on.
Yeah. Loan platform business crypto is the main thing I want to listen for.
It's going to be funny. They're going to get into the CFO is going to come on. He's going to start talking about, all the different rates at which they're selling their loans at, how well they're performing. That'll be when Tevis goes out to get food. And Chris and I are going to get really excited about the numbers. And Tevis, you're just going to see.
Throw up June's
Does this
comment.
glaze
Okay?
over?
There is a subset of people that are only here to watch me eat a burrito while listening to financial metrics, and that's fine. Like, everybody gets a little bit of what they want in the stream.
You know what? We all have our skills in life. Tevis needs to see the charts. You know, he listens to the
I'm pretty
numbers.
sure the
And
call's on. Let's start.
okay, calls on. Good luck.
All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, please press star followed by the number 1 on your telephone keypad. If you wish to withdraw your question, please press star followed by 2. Thank you. And with that, you may begin your conference.
Thank you and good morning. Welcome to SoFi's first quarter 2025 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Unless otherwise stated, we'll be referring to adjusted results for the first quarter of 2025 versus the first quarter of 2024. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release in the subsequent 10-Q filing, which will be made available next month. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you and good morning, everyone. We're off to a tremendous start in 2025 as we continue to drive durable growth and strong returns through our product innovation and brand building. Our battle-tested strategy and diverse business were instrumental in driving an acceleration in revenue growth to 33% and a 3x year-over-year increase in earnings. I'll begin by covering our key results for the first quarter, starting with our durable growth, which continues to be driven by exceptional growth in members and products. We added a record 800,000 new members in Q1, driving 34% year-over-year growth, reaching 10.9 million SoFi members. We also added 1.2 million new products, representing 35% year-over-year growth to over 15.9 million products. Our strong member and product growth powered great revenue growth in the first quarter. Adjusted net revenue was a record at $771 million, up 33% year-over-year. This is our highest growth rate in 5 quarters. Together, our financial services and technology platform segments generated $407 million of revenue, up 66% year-over-year. In our lending segment, adjusted net revenue grew 27% year-over-year to $412 million, driven by strong originations in this segment of $5.7 billion, up 30% from the prior year. Combined with $1.6 billion of origination in the loan platform business in Q1, originations reached a record of $7.2 billion. Total fee-based revenue across our business was also a quarterly record at $315 million, up 67% from the prior year. This was driven by strong performance from our loan platform business, origination revenue fees, referral revenue, interchange revenue, and brokerage fee revenue. On an annualized basis, we are now generating nearly $1.3 billion of fee-based revenue, reflecting the deliberate diversification of our business towards more capital-light revenue streams. In addition to delivering strong, durable growth, we delivered strong returns and profitability. In the first quarter, all 3 segments delivered strong contribution profit at attractive margins. Adjusted EBITDA for the quarter was a record $210 million, up 46% year-over-year. Our adjusted EBITDA margin for the quarter was 27%. Our incremental EBITDA margin was 35% as we continue to reinvest in the business to drive long-term growth and profitability. Net income was $71 million at a margin of 9%. Earnings per share were 6 cents. Finally, our tangible book value ended the quarter at $5.1 billion, a year-over-year increase of $946 million. Our strong financial performance is the direct result of our continued investments in brand building and product innovation. These investments attract new members and clients into our digital one-stop shop ecosystem and lead them to adopt more products over time. This virtuous cycle, which we call our Financial Services Productivity Loop, or FSPL, fuels our growth and ultimately our returns as we scale. In addition to product growth, we also measure the effectiveness of our productivity loop and the success of our strategy based on cross-buy. And cross-buy continues to be very strong. In the first quarter, 32% of new products were opened by existing SoFi members. Let me take a moment to discuss some of our recent investments in brand building and product innovation across our businesses. A significant amount of our marketing investment goes towards building the SoFi brand name via broad-scale, high-reach branded marketing. This investment is centered on building SoFi into a trusted household brand name, which we measure based on unaided brand awareness. Having a strong brand creates a halo effect that makes our performance marketing of each product more efficient. Our unaided brand awareness continued to be very strong through the quarter at 7%. During the first quarter, we completed the inaugural season of TGL presented by SoFi, a new tech-driven stadium golf league with 14 of the top 25 golfers in the world, including Rory McIlroy and Tiger Woods. TGL presented by SoFi attracted over 20 million total viewers on ESPN in its inaugural season. Since the SoFi brand goes everywhere the TGL brand goes, we capitalized on not just the broadcast audience reach that exceeded our expectations, but also the massive social presence as well as the exciting gameplay. We launched a promotion for SoFi Invest tied to players' performance during the playoffs. This on-air and online integrated marketing effort helped drive record engagement levels for SoFi Invest. We also continue to benefit from SoFi Stadium, as well as the continuity of our branding with the NBA and key sports ambassadors in Wyndham Clark, Cameron Brink, Jason Tatum, and of course, the OG SoFi partner athlete, Justin Herbert. Additionally, we became the presenting partner of the Country Music Association's CMA Fest. This is our first ever music partnership and an incredible platform to introduce more people to SoFi through the live event, broadcast, and social media channels. This partnership will also allow us to enhance the fan experience for SoFi Plus members through exclusive perks. Turning now to product innovation in our segments. Financial services is our fastest growing segment, doubling its revenue year over year to over $300 million. I'll touch on a few of the most significant contributions to this growth, starting with our SoFi Money business. To scale this business as rapidly as we have, we've invested significant capital to build the strong operational and regulatory capabilities that are required to have a nationally regulated bank with insured deposits, as well as earn the trust of our members. The investment, while not always obvious externally, has been transformational for our business. We've grown annualized debit spending to over $14 billion, just one of our high-margin fee-based revenue streams. We've also grown our total deposits to $27.3 billion, lowering our funding expense by an estimated $515 million per year. Along the way, we've more than tripled our money products since the end of 2021 to nearly 5.5 million today by offering an unmatched value proposition with a high APY, P2P payments, bill pay, autopilot, vaults, Zelle, 2-day early paycheck, $3 million of FDIC insurance, and unmatched rewards for checking and savings accounts, and so much more. Even with the success of SoFi Money, we are continuously finding ways to improve the member experience. For example, this quarter, we completed the rollout of self-service wires, which gives members another frictionless way to move money. We are now the only company that offers digital person-to-person payments via phone number or email address, and the ability to send money via Zelle, ACH, or self-serve wires. Given the performance of SoFi Money, we expect it to become our second billion-dollar revenue business. Another key contributor to growth in financial services is our loan platform business,
where we produce loans on behalf of third parties. In less than a year, we've grown the business to an annualized run rate of over $6 billion of originations and more than $380 million of additional high-margin, high-return, fee-based revenue. And we continue to see strong demand for these loans. This year, we finalized a $5 billion deal with Blue Owl, a $2 billion extension with Fortress, and a $1.2 billion joint venture between Fortress and Edge Focus. These additional deals will accelerate the quarterly originations well above the current level of $1.6 billion. Importantly, the LPB loans do not present any ongoing credit risk and contribute to member growth as we hold the relationship and can benefit from cross-buy into other SoFi products. So far, the vast majority of our LPB loans have been within our prime credit box, but over and above the volume we want to put on our balance sheet. However, we have the ability to also meet demand from buyers who want near prime loans with higher WAC. We can even extend this program to other loan types in the future. We are incredibly optimistic about the depth and breadth of the growth opportunities in the loan platform business, and we see it becoming our third billion-dollar revenue business. Turning to SoFi Invest. In January, we shared that we are accelerating our investment in SoFi Invest, and that decision is already bearing fruit. Q1 2025 marked an acceleration in product growth to 2.7 million products, up 21% year over year, and we expect further acceleration in Invest product growth throughout the year. The first quarter also marked our best quarter ever of member engagement, even compared to when we offered cryptocurrency or launched IPOs and alternative assets. In the first quarter, we made significant improvements to our single stock presentations, which provide members with insights to help make more informed investment decisions. Our new experience is clearer, easier to navigate, and more informative, driving positive feedback and, importantly, an increase in engagement. We also made it easier to roll over 401k assets with a more intuitive design and stronger back-end engineering, which improves completion rates and provides another great way to build long-term, durable relationships with members. We continue to expand on our unmatched selection, including investment opportunities that have been typically reserved for the high net wealth segment. Following our highly successful SPV for SpaceX last year, we've expanded our partnership with Templum so members can invest in another privately held company, Anthropic. We're also accelerating our product investment to improve the Invest user experience and drive more personalization, as well as better discovery of our Invest product offerings within our app. We want to ensure that members are aware of all we have to offer and are getting valuable insights and information that are tailored to their specific needs. The more we surface our great investment selection, the more engagement we see. So Invest stands alone in the breadth of our offering, including the ability to buy and sell single stocks without commissions or fees. Our award-winning robo-advisory product that offers 3 different themes with a total of 15 unique strategies. 4 SoFi-branded ETFs that are specifically tailored to our members' needs, IPOs, and Level 2 options. We are also providing access to alternative assets, including private equity, private credit, private real estate, venture capital, long-short hedge funds, and private individual company investments. We continue to add more selection, and by the end of the year, if all goes as planned, we will add both Level 1 options and certain crypto or blockchain offerings. Given the evolving regulatory landscape, we see an opportunity to re-enter the crypto and blockchain business more comprehensively. In addition to enabling members to invest in crypto coins, we will enter other areas over the next 6 to 24 months, but potentially much sooner via acquisition or if the changing regulatory landscape allows. Our aspirations over time are as broad and deep as they are for our existing SoFi business, including developing crypto and blockchain offerings across borrowing, investing, paying, saving, and our technology platform services for third parties. Turning to our tech platform segment. Here, the market for digitally native financial product platform is significant and continues to evolve. Recognizing the longer lead times associated with large-scale core banking conversions and consolidation among smaller fintech clients, we found innovative ways to broaden our client base. For example, this quarter, we launched a first-of-its-kind reward debit program with Wyndham Hotels and Resorts. Later this year, we expect to launch similar co-brand debit card programs with other travel and hospitality companies, further expanding our footprint among consumer brands. And we recently signed a deal with Mercantile Banco, which offers personal and business banking services in Panama and will use our Cyberbank digital banking platform. We are pleased with the demand from new client opportunities for the tech platform business and expect these wins and others in the RFP process to have an impact on our revenue in 2026 and beyond. Now turning to our lending segment, starting with our home loans business. Our 2023 acquisition of Wyndham Mortgage strengthened our technology and fulfillment capabilities, creating significant capacity for growth. In Q1, this helped us grow home loan originations by 54%. At the same time, we've expanded to offer home equity loans, a great value to members given the fact that they are sitting on low-rate mortgages that they do not want to touch in a higher rate environment. This product, which we didn't have a year ago, accounted for more than 1/3 of our home lending volume during the first quarter. It was our best quarter ever for home equity originations and should only go higher from here. As interest rates come down, we expect in our planning for a significant acceleration in the demand for home loans for both home purchase and refinance. We're also launching new personal loan and student loan refinancing products. The new personal loan product launching next month will be for prime credit card customers that carry a revolving balance and are making mostly interest-only payments. These are commonly referred to as revolvers. Members will now get a fairly priced deal instead of being gouged by credit card companies and big banks who charge 20+% interest to earn an ROE of 50% on some of these prime credit revolvers. We will meaningfully cut the cost of debt for this prime borrower, reducing monthly payments by as much as 40%, while generating an attractive target ROE in line with the 30% that we generate on our broader personal loan portfolio. So all you premium credit card holders out there that somehow found yourself with $10,000 to $30,000 or more of debt on your credit card that you're now only making minimum payments on, we are here to help get rid of that debt and get your money right. In the midst of uncertainty around student loan options in the market, we just launched an innovative member-centric refinancing solution known as Smart Start. This allows for lower payments in the early part of the loan and steps up into paying regular payments after this introductory period, helping members find their footing and build long-term savings. Yet another way we innovate to help our members spend less than they make and invest the rest. Let me wrap up the discussion on our results, branding, and product innovation with a perspective on SoFi Relay and SoFi Plus. Both products make their footprint bigger than their foot and are critical elements of our financial services productivity loop. SoFi Relay allows members to easily track and manage all their SoFi and non-SoFi financial products and accounts on our digital platform through an easy-to-use dashboard. Relay is our second largest product at $5 million, which is up 41% year-over-year. Although Relay doesn't generate revenue directly, it is a lightweight starting point and serves as the tip of the sword with very attractive cross-buy patterns into other SoFi products. As an example of Relay's impact, 1/3 of the Relay First members that cross-buy adopt at least 3 products, with the most common sequence being Relay to Money to Invest. Turning to SoFi Plus, our premium membership tier that brings together the best of all we have to offer through America's most rewarding financial membership, unlocking over $1,000 in value each year. Previously, members needed a direct deposit with us to be a SoFi Plus member, but during the first quarter, we added a fee-based subscription option as well. While this option is new, we are already seeing some promising behaviors among early subscribers. Nearly 90% of the new Plus members were already existing members, demonstrating the validation of making this product more accessible via a pay option, not just via direct deposit. The product has also been a catalyst for our FSPL, driving the second-order effects of cross-buy among these members, with nearly 30% adopting an additional product within 30 days of enrollment. Among SoFi Plus subscribers who are completely new to SoFi, over 75% adopt at least a second product, and over 40% adopt a third product within 30 days of enrollment. Importantly, these members are adopting products across our platform beyond just SoFi Money. This data demonstrates that members truly value the one-stop shop model, and by exposing members to our complete offering, we can accelerate cross-buy. Hopefully, it is as clear to you as it is to me that our strategy continues to deliver great results. That is why we have decided to further accelerate our rate of innovation while still being able to increase our full-year guidance. Our value proposition has never been more relevant to the members and clients we serve. We are stepping on the gas to launch new products faster and iterate to improve our existing products at an even more rapid pace. The opportunity in front of us is too massive to risk underinvesting to capture it. I'll be back after Chris covers the detailed financial results and guidance to spend a few more minutes talking about this important topic and the strength of our competitive position.
Thank you, Anthony. It has been a strong start to the year as we continue to drive durable growth and strong returns. We exceeded each metric that we guided to during our last call on the way to delivering accelerating revenue growth and our sixth consecutive profitable quarter. For the quarter, revenue grew 33% year over year to a record $771 million. Adjusted EBITDA was also a record at $210 million and a margin of 27%. Net income was $71 million at a margin of 9%, and earnings per share was 6 cents. This included a small benefit of about a penny related to a lower than expected effective tax rate. An important driver of the acceleration of growth was the increased contribution from capital-light non-lending as well as fee-based revenue sources. Our non-lending businesses generated $407 million of revenue, up 66% year over year, and we also generated record fee-based revenue across all businesses of $315 million, up 67% year over year. Turning now to our segment performance. In terms of financial services, for the first quarter, net revenue was $303 million, more than double that of Q1 2024. Contribution profit was $148 million, up 4x from last year. Contribution margin was 49%, almost double what it was last year. Net interest income for this segment was $173 million, up 45% year over year, which was primarily driven by growth in member deposits. Non-interest income grew 3.2x to $130 million in the quarter, which equates to over $500 million in high-quality fee-based income on an annualized basis. Importantly, improved monetization continues its strong contribution to revenue growth. Financial services revenue per product increased from $59 in the first quarter of 24 to $88 in the first quarter of 25. That's up nearly 50%, and we see continued upside as newer products mature. In Q1, our loan platform business generated $96 million in adjusted net revenue, up 44% from just last quarter. Of this, $93 million was driven by the $1.6 billion of personal loans originated on behalf of third parties, as well as referrals. I would note that these originations were up 41% quarter over quarter, while the associated platform fees increased approximately 50%, reflecting stronger monetization within this business. Additionally, LPB generated $3 million from servicing cash flow, which is recorded in our lending segment. The growth opportunity for this business continues to be strong. On the heels of launching our $5 billion partnership with Blue Owl Capital in Q1, we are pleased to have recently secured an additional $3.2 billion through a one-year, $2 billion extension with Fortress and a two-year, $1.2 billion agreement with a joint venture between Fortress and Edge Focus. These partnerships continue to demonstrate the attractiveness of our loan production to investors. In addition to our LPB revenue, we continue to see healthy growth in interchange, up 90% year over year, driven by close to $16 billion in total annualized spend in the quarter across money and credit card. Shifting to our tech platform. For the first quarter, we delivered net revenue of $103 million, up 10% year over year. Contribution profit was $31 million at a contribution margin of 30%. Revenue growth was driven by continued monetization of existing clients, along with new deals signed in new client segments. We saw a slight decrease in accounts to 158 million, or 6% year over year, while revenue still grew 10% year over year, with similar growth and potential acceleration in Q2. This was driven by a large client's decision last year to diversify their processing providers, which was factored into our outlook for 2025. We continue to diversify our client base by winning new business, and we expect these wins to drive financial performance and an offset in 2026. Turning now to our lending segment. For the first quarter, adjusted net revenue was $412 million, up 27% from the same period last year. Contribution profit was $239 million, with a 58% contribution margin. These strong results were primarily driven by growth in net interest income, which increased 35% year-over-year to $361 million. During the last quarter, we had record total loan originations of $7.2 billion, up 66% year-over-year. Personal loan originations were a record at $5.5 billion, of which $1.6 billion was originated on behalf of third parties through LPB. In total, personal loan originations were up 69% year-over-year. Student loan originations were $1.2 billion, up 59% from the same period last year. Home loan originations were $518 million, a 54% year-over-year increase. Capital markets activity was very strong in the first quarter. We sold and transferred through our loan platform business $3.1 billion of personal and home loans. In terms of personal loans, we closed $1.1 billion of sales in whole loan form at a blended execution of 106.2%. All deals had similar structures to other recent personal loan sales, with cash proceeds at or near par, and the majority of the premium consisting of contractual servicing fees that are capitalized. These sales included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would have otherwise had if we had held on to the loans. Additionally, we sold $90 million of late-stage delinquent personal loans. By selling these loans, we're able to generate positive incremental value over time versus selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. In terms of home loan sales, we closed $322 million at a blended execution of 102.1%. In addition to our personal and home loan sales, we executed a $698 million securitization of loans originated through our loan platform business. This was the first securitization of new collateral in our SoFi Consumer Loan Program, or SCLP, since 2021, and the first using collateral originated in the loan platform business. Importantly, this channel provides our partners with meaningful liquidity to support their ongoing investment in the loan platform business. The transaction priced at an industry-leading cost of funds levels with a weighted average spread of 87 basis points and an all-in yield of 5.10%. Turning to credit performance, the health of our consumer remains strong. Despite the market volatility, we are not seeing signs of weakness. Our personal loan borrowers have a weighted average income of $158,000 and a weighted average FICO score of 743, while our student loan borrowers have a weighted average income of $134,000 with a weighted average FICO score of 769. Our credit trends continue to be strong after seeing delinquencies peak 1 year ago in the first quarter of 2024. For personal loans, the on-balance sheet 90-day delinquency rate was 46 basis points in the quarter, a decrease of 9 basis points sequentially. The annualized charge-off rate also declined to 3.31% versus 3.37% in the prior quarter. Had we not sold any late-stage delinquencies, we estimate that including recoveries between 90 and 120 days delinquent, we would have had an all-in annualized net charge-off rate for personal loans of approximately 4.8% versus 4.9% last quarter. For student loans, the on-balance sheet 90-day delinquency rate was in line with last quarter at 13 basis points, while our annualized charge-off rate decreased 15 basis points to 47 basis points. The data continues to support our 7 to 8% maximum life of loan loss assumption for personal loans, in line with our underwriting tolerance, although we continue to trend below these levels. Our recent vintages originated from Q4 2022 to Q2 2024 have net cumulative losses of 4.09%, with 43% unpaid principal balance remaining. This is well below the 5.53% observed at the same point in time for the 2017 vintage, the last vintage that approached our 7 to 8% tolerance. The gap between the newer cohort curve and the 2017 cohort curve widened by a more favorable 16 basis points after widening improvements of 15 basis points in Q4. Additionally, looking at our Q1 2020 through Q4 2024 originations, 59% of principal has already been paid down, with 6.7% in net cumulative losses. Therefore, for life of loan losses on this entire cohort of loans to reach 8%, the charge-off rate on the remaining 41% of unpaid principal would need to be approximately 10%. This would be well above past levels, further underscoring our confidence in achieving loss rates below our 8% tolerance. Turning to our fair value marks and key assumptions. As a reminder, we mark our loans at fair value each quarter, which considers a number of factors, including the weighted average coupon, the constant default rate, the conditional prepayment rate, and the discount rate comprised of benchmark rates and spreads. At the end of the first quarter, our personal loans were marked at 105.5%, up 55 basis points from the end of the prior quarter. This change was primarily a function of the discount rate decreasing by 42 basis points to 4.87% due to the underlying benchmark rate decreasing by 34 basis points and spreads tightening by 8 basis points. As we've previously noted, both of these changes are empirical, based on actual market data, not assumptions. Additionally, any fair value impacts that resulted from interest rates increasing were offset nearly 1-for-1 by hedge losses. Additionally, the annual default rate decreased by 18 basis points. Slightly offsetting these impacts was a 14 basis point decrease in the weighted average coupon and a 52 basis point increase in our conditional prepayment rate. When a borrower prepays, we are still capturing the principal, and the impact to the value of the asset is only based on the premium above par at a given point in time, which is very small relative to the principal outstanding. At the end of the first quarter, our student loans were marked at 105.2%, up 107 basis points from the end of the prior quarter. This change was a function of the discount rate decreasing by 18 basis points to 4.22%, driven by the underlying benchmark rate decreasing by 38 basis points, partially offset by 20 basis points of spread widening, and a 10 basis point increase in the weighted average coupon. There were no material changes to the annual default rate or the conditional prepayment rate. Turning to our balance sheet. In the first quarter, total assets grew by $1.5 billion, driven by $1.6 billion of loan growth and approximately $265 million of growth in cash, cash equivalents, and investment securities, partially offset by a reduction in other assets. Total company-wide cash at quarter end was $2.7 billion. On the liability side, member deposits grew by $2.2 billion for the quarter, bringing total deposits to over $27 billion. Net interest margin was 6.01% for the quarter, up 10 basis points sequentially, reflecting our ability to sustain healthy deposit versus lending betas. This included a 27 basis point decrease in cost of funds, which was partially offset by a 13 basis point decrease in average yields. We continue to expect a healthy net interest margin above 5% for the foreseeable future. In terms of our regulatory capital ratios, we remain very well capitalized. Our total capital ratio of 15.5% at quarter end remains comfortably above the regulatory minimum of 10.5%. Tangible book value grew more than $167 million sequentially to $5.1 billion, and tangible book value per share at quarter end is $4.58, up from $3.90 a year ago. Let me finish by providing our revised outlook for 2025. Given our strong start to the year, we continue to expect to add over 2.8 million members, which represents at least 28% year-over-year growth. We now expect adjusted net revenue of $3.235 to $3.310 billion, above our prior guidance of $3.2 to $3.275 billion. This equates to year-over-year growth of approximately 24 to 27%, an increase from our prior guide of 23 to 26%. We now expect an adjusted EBITDA of $875 to $895 million, above our prior guidance of $845 to $865 million. This represents a 27% margin. We now expect adjusted net income in the range of $320 to $330 million, above our prior guidance of $285 to $305 million, and adjusted EPS of 27 to 28 cents, above our prior guidance of 25 to 27 cents. We now expect growth in tangible book value of $585 to $600 million for the year, above our prior guidance of $550 to $575 million. For the second quarter of 2025, assuming credit spreads are in line with the range we've observed year to date, we expect to deliver adjusted net revenue of $785 to $805 million, adjusted EBITDA of $200 to $210 million, adjusted net income of $60 to $70 million, and adjusted EPS of 5 to 6 cents. Overall, it's been a strong start to 2025, and we're looking forward to a great year overall. I'll hand it back to Anthony to wrap us up and kick off the Q&A.
Thank you, Chris. As I mentioned, our strategy and execution continue to deliver excellent results. The opportunity in front of us remains massive, and we are accelerating our investment in new product launches. We are building from a position of strength as the only digital company to successfully scale members and revenue across 5 lending businesses, a world-class SoFi Money offering with $27 billion in total deposits, and invest in credit card offerings with 2.7 million products and over 300,000 cardholders, respectively. At the same time, we're incubating and beginning to scale our SoFi Protect offering across home, auto, and life insurance, lending and checking products for small and medium businesses, and of course, our recently launched SoFi Plus product with the best value in a financial services subscription offering. Additionally, we've seen tremendous scale and indirect value creation from SoFi Relay with over 5.1 million products. Despite all of that success, we built an entirely new loan platform business in less than 12 months, generating a $380 million annualized high-margin fee revenue stream. And of course, our technology platform business serving over 158 million accounts and over 8 billion annualized transactions while helping power the SoFi products. Make no mistake, within each business, we have or will have superior speed, capabilities, and services when compared side by side to alternative offerings, as product quality is critical to being a member-centric company. But having great products is not enough. We must also have a sustainable competitive advantage. In that regard, we believe our unique strategy, the combination of our businesses, and how we have architected our products results in building a sustainable competitive advantage and having the highest lifetime value per member. Our highest lifetime value is built on the back of striving to have superior unit economics on a per-product basis, combined with significantly lower cost and more products and revenue per member, such that we can provide more value in each product and more value when they are used together. And we can do this better than anyone else. Specifically, our competitive advantage allows us to offer superior and even one day unmatchable value to our members in the broadest selection of loans with the best interest rates, superior APY and deposits, the best value in a financial service subscription product in SoFi Plus, the broadest selection in invest products and competitive matches on invest rollovers, a fully comprehensive suite of products all in one device, which is necessary to get your money right, as well as SoFi Rewards across all of our products and services, free financial planning with the CFP, discounted travel offerings, and other spend better offers. Additionally, we provide free services like Relay, Autopilot, Vault, Zelle, and P2P. And finally, several new AI-driven products in development that will specifically show our members how to get their money right by spending less than they make and investing the rest, like the SoFi Expense R and SoFi Cash Coach, just to name a few. In total, SoFi's unmatched value across its products and services make it the best place to help members achieve the most critical factors in their financial life, which is how to spend less than they make and invest the rest in order to get their money right and realize their ambitions. All that we do must serve this simple but hard to achieve equation better than anyone else. Hopefully, our leadership position as a one-stop shop in our competitive advantage with the highest lifetime value is clear, as well as why we want to accelerate our rate of investment and innovation to take advantage of the incredible competitive position we have built. In my mind, our path to our ambition is simple: Given the superior competitive position we occupy, the only thing that stands in the way of us and our aspirations is, well, us and our ability to maintain a founder's mentality culture to further strengthen our competitive sustainable advantage. With that, let's begin the Q&A.
Thank you. At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. Please keep in mind we'll only take 1 question per person at a time. Please rejoin the queue for any additional questions. And our first question today comes from Andrew Jeffrey at William Blair. Andrew, your line is open. Please go ahead.
Hi, thank you very much. I appreciate you taking the question. Terrific results here. Anthony, I know it might be a little bit of a difficult question to answer, but as I look at the very impressive performance of the loan platform business, can you envision a time where SoFi is just materially a fee-based business? And what are the implications for that for deposits, which also for different interest rate environments? I just wonder, do you wind up with excess funding and do you grow loans faster? Primarily on the platform.
Yeah, I think you're a little broken up there. I think I got the bulk of your questions. I think the question was, do you see a time where where we transition to a largely fee-based business? I think you'll see us increasingly change the mix to greater fee-based than we are today. 41% on an annualized basis is the percent of our revenue from fee-based revenue today. It's broad-based, so it's not just the loan platform business. Interchange is becoming a bigger part, in addition to referral revenue, in addition to our ability to drive fees in other smaller businesses that aren't as visible, like our insurance business and our small medium business, which is both loan referral fees as well as checking and savings fees. So I do think it will continue to increase quite meaningfully, but not just because of the loan platform business. I think the thing that would drive it even higher than we anticipate, which we do imagine it's going above 50%, is if we can do the loan platform business meaningfully outside of our credit box. Today, the bulk of our loan platform business is in and about our credit box, just volume that we wouldn't otherwise want to originate on our own balance sheet, both from a credit and risk standpoint. If we can actually deliver loans in the loan platform business that are meaningfully outside the credit box, say 600 to 680, then the revenue stream there is going to be even much, much larger than it is today. We are working on that. I'm optimistic we can get some of those deals done. We announced a piece of that today with Edge Focus, but there's a couple of other deals that are quite large that could be pretty meaningful that would drive that higher. The other thing I'd say about the invest business is that, our outlook and what we're contributing today does not include crypto, which will also be a fee-based business in the invest product itself, but also that we could have a stablecoin pay product with high yield that could drive fees as well, in addition to doing things that I mentioned earlier in the call outside of invest or stablecoins. The thing I'd say more broadly about this business and our desire to own loans, we do want to put loans on the balance sheet and sell those loans and hold them for sale. Our student loan financing business is an important product for us to have. We have that held for investment on a big piece of it, but we'll manage to the best ROE. And that's what will be our guiding light. We want to have an ROE that's in the 20 to 30% range. And so we have to have the right mix of products. So it can't all be fee-based, but we'd like it to be more than 50% for sure.
The next question comes from Kyle Peterson at Needham & Co. Kyle, your line is open. Please go ahead.
Great. Good morning, guys. Nice results, and thanks for taking the questions. I wanted to touch a little bit on, specifically the tech platform and pipeline. I know you guys have a lot of wins that are kind of coming live later this year, but just wanted to see if, given some of the recent market volatility and kind of macro uncertainty, has there been any change, whether it's in client appetite or decision making, or any slowing or change in activity that we should be mindful of, given the volatility over the last few weeks?
No change in our outlook for the tech platform business. Long term, we still have a very strong conviction that is important for the SoFi businesses and helping us deliver our sustainable competitive advantage in the highest lifetime value. Owning that tech allows us to not just have lower costs, but allows us to have superior unit economics and allows us to innovate at a much faster rate. And so it is a part of owning it is for the SoFi business. But the other piece is providing the rest of the world technology services. And our outlook for that
is unchanged, even with the more recent volatility around tariffs and the economy and other concerns. We've signed a number of partners that will be integrated this year, and they'll contribute to revenue in 2026. Our outlook for this year is unchanged in terms of revenue guidance as well as longer term. I do think there could be an acceleration in 2026 relative to 2025 in terms of the number of new deals won and the impact they could have, because of the fact that people are starting to move more aggressively into innovative areas and they can no longer compete from an innovative standpoint. If you're a traditional financial institution or you're a big consumer brand that has financial services products, you really have gotten away the last 3 years without innovating. And the reason we've gotten away with it is because of the regulatory environment, because of the backdrop of the economy and interest rates going higher. But in an environment where interest rates stay stable where we're at and we have a stable economy, these financial institutions need to start to compete or they're going to keep losing share. You can see the rate of innovation happening in the private markets. We have more inbound calls than we've ever had for acquisitions and more inbound calls for partnerships than we've had in 3 years. And it's because of the fact that capital is coming back to the fintech sector. It's because the interest rates are now stabilizing and people can start to reinvest. So that's the opportunity set for us. It's up to us to deliver, and we feel confident we'll be able to deliver our share against the tech platform business and for SoFi more broadly for that matter.
The next question comes from Dan Dolev from Mizuho. Dan, your line is open. Please go ahead.
Hey, team, Chris, Anthony, really, really nice results. Great to see that. Can I ask you guys about the strength of the capital markets in this market, given the high volatility looks really strong? Would like to get some perspectives on that. Thank you.
I'll let Chris add in more holistically, but I'll tell you when the tariff and volatility stuff happened, I thought some of our deals would get delayed in investment committee or other factors. And we've seen that happen in the past when you had shelter in place for COVID, things came to a screeching halt, and other things have happened in the last 7 years related to dislocations and liquidity, et cetera. We didn't see any slowdown. When the tariff and volatility stuff happened, there was no slowdown. In fact, people were moving just as fast, and it was a pleasant surprise. So that's on the near term. I'll let Chris talk about more holistically the appetite for our assets and the general sector trend that we're seeing.
Yeah. So overall, the strength of the capital markets remains extremely strong, including the loan platform business. This quarter, we ended up selling or transferring over $3 billion of personal and home loans at really strong execution levels. That's over $12 billion of annualized demand in Q1 alone. And then, as we mentioned in our prepared remarks, we also signed over $8 billion of LPB partnerships between Blue Owl, Fortress, and Edge Focus. These recently announced partnerships and other deals are going to drive an acceleration in LPB volume in Q2. So overall, really pleased with how the LPB business has developed, and we're feeling good about the demand, both from capital markets investors as well as from our members.
And I don't think people truly appreciate this stat. We underwrite around $20 billion of loan originations, give or take. And that's not meant to be guided, it's just a round number. We decline $100 billion of loan applicants. $100 billion. That means we've done all the work of building our brand, of driving the demand, of going through an application process to tell more than $100 billion no. That is a huge opportunity for us, and it's going to be high margin, no capital required, low credit risk. Obviously, those loans are being taken away a couple of days after they're underwritten. So it is a big opportunity. So don't sleep on the loan platform business holistically.
The next question comes from Jeff Adelson from Morgan Stanley. Jeff, please go ahead. Your line is open.
Hey, good morning. Thanks for taking my questions. Just a couple questions from me. Can you talk a little bit more about how you might position the student loan business if Congress ultimately decides to cap some of the programs out there and Grad Plus, Parent Plus? I know historically that's been more of a source for your refi business over time. Would you be looking to do a little bit more on the in-school graduate side if that happened? And Chris, if you could also just maybe touch on the take rate and the loan platform business. It looked like it increased on the non-referral side this quarter up to about 4.7% as a percent of those originations. So should we be thinking about that as kind of like the sustainable run rate from here, or should it Was there anything sort of one-off in that number? Thanks.
So Jeff, on your first question as it relates to student loans, you're really referring to the in-school student loan market. That's a product that we launched 6 years ago. It's an important product in terms of our mission, being there for all the major financial decisions in our members' lives and the days in between. So if the government backs away from providing in-school loans, Grad Plus, et cetera, we'll absolutely capture that opportunity. By the way, those loans are a lot more attractive than our refinanced student loans. They come at a higher WAC, and they're also typically backed by a co-borrower and a parent. And so they're great ROE products, and we would love to do as much as we can in that market. And we'd be very happy to step in for the government. In addition to the fact that we would not only underwrite the in-school loans, when those students graduate and go get jobs and drive great credit scores, we'll refinance those loans. So it'll be a double bottom line from the standpoint that it's a revenue stream sort of day one, but it's also a member that becomes part of the ecosystem of SoFi. And there's going to be a high lifetime value to someone that takes out an in-school loan from us relative to someone that refinances from us.
Yeah, and then on your second question as it relates to the loan platform business take rate, we are really excited about the momentum that we have there and our improved monetization. You saw that quarter over quarter. I think part of it is as a result of the excess demand that we're seeing from loan investors, which is enabling us to create some pricing tension in some of these partnerships. In terms of the long-term guide on the take rate, what I would think about is each deal is structured a little bit differently. And the majority of the deals that we've done have been within our credit box or stuff that we would otherwise hold on the balance sheet, but we haven't because we're happy with the size of our balance sheet. As we start addressing the large TAM that Anthony mentioned of the $100 billion that we're currently declining right now on an annual basis, you'll see that take rate fluctuate.
The next question comes from
But
Devin
overall,
Ryan
the only
from
other thing
Sorry, go ahead.
Yeah, sorry. Before you go, Devin, the only other thing I would say is that overall the economics remain extremely healthy. These are high margin unit economics for the LTB business.
Go ahead, Devin. Your line is open.
Okay, great. Good morning, Anthony and Chris. How are you guys?
Great.
Just a question on, yeah, good. So question on just kind of volatility in the market, kind of post quarter end, obviously a lot of moving parts here, but one piece of forward Fed fund expectations have come down quite a bit over the past month. And just curious kind of how we should think about implications on deposit costs, what type of betas you guys are estimating, and then also what are the implications on deposit growth if short-term rates follow market expectations? Thanks.
Yeah, Chris and I will tag team this. In the quarter, you saw that our members within SoFi Money grew 41%. Our deposits grew 52%. So we're seeing positive deposit trends, not just from new SoFi Money members, but from existing deposit members. What I'd say is this: we have a competitive advantage. And that competitive advantage is that we have an insured depository entity in a SoFi bank, and we have 4 loan products. Most companies that are not banks that are providing an interest rate on deposits are doing it on the back of a sponsor bank. And those deals are limited in terms of what the APY they can offer. They're typically Fed funds plus 20 basis points. It can't be more than that. And if it is, it's marginally more, maybe Fed funds plus 30 basis points. It is limited. And so it's a really tough strategy to try to live in a world that you want to be a holistic one-stop shop and have a limit on what you could do in any product, whether it's an interest rate on loans or interest rates on deposits. We have an unencumbered capability to compete on APY if we need to, and we will, because we have such a strong ROE business from our lending business that can fund those deposits. And so on the margin, I don't know anyone that can outcompete us on the APY. Now, you may say, geez, Anthony, there's banks with $1 trillion of assets that can do it. They are not going to do it. They could if they chose to, but they're not going to do it. They have a deposit base that is a super low cost of funds, and they have no interest in raising the APY to have more deposits because they just don't need it to lend. But the people that want to get into the business and compete with us with primary accounts, they're not going to be able to compete with us unless they become a bank and they have the lending business to fund that APY. So I couldn't feel better about our position there and how competitive we can be. And again, it will just drive that viral capabilities of all of our products and cross-sell and cross-buy. But I do think APYs are largely going to come down in the industry, but ours is going to be in that top tier and maintain that top tier. We've never gone to the state of where we needed to be at the very top and to maybe even use it as a loss leader. I don't think we have to get there, but we actually have the capability to do it and make it up on the lending side. So I couldn't be more enthusiastic about our competitive positioning. And there's a lot of noise people are making out there that they want to compete with us in that area, and I welcome it.
The only other thing I would add, because Anthony kind of hit on the betas, but to put some more specifics, historically, we've been operating in the 65 to 70% deposit beta range. In terms of overall outlook and what's baked into our guidance, we're at the point where we're at our long-term funding target of about 85 to 90% of being member deposit funded. So all else being equal, we'd like to grow total deposits at a similar pace to overall loans, which we've said in the last earnings call of single-digit billions. However, if we're continuing to see exceptionally strong member demand, we can grow a bit faster and deploy that funding into funding incremental loans or other assets. And then we also have other ways that we can manage deposits on the balance sheet. So we're not going to stymie member growth at all costs.
The next question comes from Reggie Smith from JP Morgan. Reggie, please go ahead. Your line is open. Either Reggie,
Reggie, maybe on mute.
locally, please.
Sorry about that. Congrats on the quarter. A lot of questions about, kind of macro uncertainty. And these times are very unique in the sense that, I can't think of another period where we had a pre-signaled, potential shock. Usually things happen and we don't know that they're going to happen. I guess my question, Anthony, is how, and it sounds like your funding partners have not linked at all, but I'm curious how you guys underwrite or approach underwriting in this type of environment where you've got, potentially like a binary outcome. Have you made any changes or like how are you guys approaching that specific to your personal loan business? Thank you.
Yeah. So from a credit policy standpoint, we have an early warning dashboard across a number of external, internal, macro, and microeconomic factors that kind of dictate how we approach credit. In the past, when those indicators have become red, we cut back on credit and we tighten our credit box. We can underwrite across 8 different tiers. There is a period in the last 3 years where we cut back tier 8, tier 7, and tier 6 and just underwrote through tier 5. We're, as Chris has talked about multiple times, we're managing to a lifetime loss of 8%. Well, in a recession, life of loan losses go up. The way you maintain an 8% life of loan loss when losses go up because of a recession or dislocation is you stop underwriting those higher tiers that have higher losses. So that's philosophically how we approach it and from a credit policy standpoint. The economic indicators, they're definitely volatile right now, but not to the point that we need to change our underwriting standards. And our credit performance has remained really strong. We look at entry rates, we look at 90-day delinquencies, and obviously we look at NCLs, all of which have continued to improve and remain very, very steady. I'd say the American consumer is actually doing quite well, and we haven't seen signs that cause us to get a bit concerned. We're 100% willing and able to change on a dime if we need to, but so far, no issues.
Final question today comes from Terry Ma at Barclays. Terry, please go ahead.
Hey, thank you. Good morning. I just wanted to follow up on the Parent Plus and the Grad Plus opportunity. I guess the question is, can you have that kind of in-school grad product coexist with your current refinance business? Because on one hand, I get that it's higher WAC, higher ROE, but then you're also a big consolidator of those loans. Thank you.
Yeah, it absolutely can coexist. There's nothing wrong with prepayments. You just have to factor that into how you value the loans. So if someone's in school and they've taken out 4 years of loans from us, they have a great relationship with us. Hopefully they have a SoFi money account and maybe even a SoFi credit card and maybe a small invest account as well. As they get out of school and their credit improves and they can refinance at a lower rate because they have a credit rating that warrants it, we'd love to do that loan. We just have to make sure that as we think about the in-school loans and as we value them, we have the right type of prepayment levels. We have a great history in in-school loans and a great history in refinance loans to know what those prepayment rates are and how to have them coexist. But our goal is to get people out of debt. Our goal is to help them reduce their debt so they spend less than they make. Spending less than they make involves debt. It's not just their entertainment spending and their household expenses and their transportation expenses and everything else they spend money on. It's also debt. So our objective is to help people spend less than they make and invest the rest. So if we can lower their cost of debt, we would love to do that. That's our mission. Refinancing our own loans, I have no issue with that. Even on the personal loan business, if we underwrite somebody at a 14% WAC and we help them improve their credit score from 680 to 810, we should absolutely help them refinance that loan. And by the way, we'll make more money in refinancing that loan than we would if they just kept their current loan. It's just we can't overvalue the current loan, and that's why we look at prepayment speeds all the time, just like we do on servicing assets and how we approach things holistically. The member is at the center of what we're doing, not our financial model.
At this time, I would like to turn the call back over to Anthony Noto for closing remarks.
Thank you all for dialing in. We have clearly demonstrated an ability to identify opportunities, lean into those areas that will have the greatest impact, and execute with excellence. And that's because we have a company of great people, a company of people that are focused on building the best culture in the world. And that is the asset that we will ultimately continue to leverage on top of the opportunity that sits in front of us. Our results, in my mind, continue to show that we have a diversified, resilient business that has delivered and will continue to deliver strong growth through a variety of environments, including dynamic environments like we see today. We remain focused on the path to our aspirational long-term goals by executing day to day and fighting the battle right in front of us. As we look ahead, we're confident that the investments we are making today will generate the results that we need to achieve our ambitions. With that, thank you for your interest, and we look forward to talking to you next quarter.
Goodbye.
This concludes today's conference call.
You're muted.
First thoughts? Tevis?
This is an easy hold. Like, it's just they keep executing. The company just keeps compounding. They like the way that they're building the business is, I mean, it's not flashy, honestly, but it just keeps getting better. They keep getting more diversified in their offerings. I think that trend is only going to continue. Like, it's such an easy hold at this point.
Yeah. Tevis?
Yeah, I really like the details around the loan platform business. They kept harping on that $100 billion that they reject and how that forms the TAM for the loan platform business if they can widen their credit box. So that's going to be interesting, right? Because right now we've seen deals. I mean, well, from what we've heard, it's relatively within their credit box. And Chris Lapointe was mentioning that at the very end, there in the calls, saying that, these are things that we could do ourselves. But once that loan platform business starts expanding out of that credit box, I think that's really where you're going to see, even more synergistic growth and acceleration in that business. And that's really cool. Like, that's really cool to see. I saw a little jab at Robinhood there saying, hey, look, we have a competitive advantage because we can have a bank charter that allows us to not be anchored in terms of the APYs that we can offer. And everybody else who doesn't have a bank charter is going to be limited to what they can offer there in terms of their benefits. Level one options, crypto, like that was interesting to see. I found it interesting how he mentioned through acquisition, because them buying a crypto company was on my bingo card for the year. So TBD. It sounded really far-fetched, right, when we're making these predictions in December of like SoFi buys a crypto company this year, but just how it shook out with the administration moving really fast from a regulatory perspective and crypto coming back. Like, I mean, you almost nailed it, Tanner, in Q1. It's going to realistically come back in Q2. But the success or failure of crypto coming back, I'm really viewing it more so in terms of what net new aspect of crypto do we get. I don't really see it as like, oh, they had commented out the code for their brokerage and now they're just like bringing the code back from their brokerage perspective and we're back to where we were in 2023. Like I really see it as, okay, all of these asset-backed lending, all of this expansion into the crypto sector is where I'm going to see the majority of that innovation in terms of how aggressively they're going to move into that. And we've been seeing from the hiring that they're moving fairly quickly. I think an acquisition there would really be an interesting dynamic because then you could make a real argument that they are, more demanding of a hybrid valuation, right? They have this diversified business offering in crypto, especially like stable coins and having crypto-backed loans, so on and so forth. Hopefully the tech platform business ramps up by that time, which they said, they are expecting for it to ramp up as a result of the deals that have come through and the revenue that's going to actually manifest on the financials in late 2025, 2026. And so with all of these things playing a part, loan platform business is going to be a much bigger chunk of the total revenue mix by that time as well, that in a year or 2 years from now, like you could really see a more diverse landscape of where this business is playing in and how that synergy could work across the entire ecosystem.
Yeah. No, I'm insanely excited.
You sound it.
SoFi Plus is, well, I mean, it's early. I do think though that, SoFi Plus is now going across the entire platform. Hopefully we see a reacceleration in multiple product attachments. If that happens, they are going to beat by revenue much faster than what people had guided for. Yep. If Wall Street started to see a trend for product attach actually slowing down and that the amount of products per member had been slowing, then they're going to guide for that. If that starts to reaccelerate, they're going to have to completely adjust their models. And not only that, but each individual product themselves is getting more profitable than they have before. So, we're seeing more spend on credit cards. We're seeing less defaults there. We're seeing, more revenue on the invest side, more products. Like even invest is counted as a single product, but it's not. The product offerings within invest are expanding. Just like what they said with the ability to actually buy Anthropic directly. We'll have to see the total amount that people are actually going for these types of Cosmos funds. But that all fits into an invest product itself. So all in all, if they continue to add more quarters that add on a million new products, we're going to be happy campers. And I think that's what we're going to see for the rest of 2025. It's expected to be large growth quarters. I think that you can continue to expect this 800 to 1 million new members for the rest of the quarter. I think 800,000 or at least 700,000 will be the new bar, not 5 to 6.
I mean, yeah. And this is, I think, where we have some crazy expectations that are put on them as a result of their own sandbagging. They've conditioned this into us, by the way. But the fact that I was kind of disappointed with 800,000 new member additions, like, it is kind of crazy.
The first time they've ever been at 800,000 and in a quarter that's shorter because it's a February.
Exactly.
Record beat, not enough.
Exactly. And I'm saying like, okay, well, that was great in the grand scheme of things. Absolutely. It's just crazy that our expectations are so much higher than what the streets is. Because, I mean, this is what they've conditioned us to believe.
Yeah. He did say 2.8 million members, TJ. They also had a similar expectation last year, which was also
minimum 2.8 million members for the year.
Right. All I'm saying is that they had those similar expectations last year, and they were also conservative. So,
yeah. 2.8 million members is like what, 28% year-over-year growth or something like that. I think I read in the press release. It's like, it's not that crazy.
I think it'd be more than that. I think it's closer to 34%.
Regardless, it's a sandbag number, dude. Like, they're gonna come in realistically well above 3, probably closer to 4.
Yeah. So 700K is the new base. I mean, if you divide it by 4, but we've already added 800. Yeah. Anyway, we're being picky. Yeah. We're already past 11 million members. If you think by the end of the year we'll be at 13 million or so, like, I don't know. I think it's insanely exciting whenever people look back and they look at that, member adoption rates and realize that those members turn into checking account members, maybe at first whenever they're young,
Yeah.
debit card spenders, credit card spenders, personal loan lenders.
On TJ's point, right? Like, 700K is absolutely not the base, because in a vacuum, sure, you could say, okay, well, minimum 2.8 million, 700K is the base. But like, did you hear what he was saying about crypto coming back? Like, that is going to accelerate members, especially if they have some new offering around crypto. It's going to accelerate members.
I don't actually think that's going to accelerate members. I don't think anyone gives a crap.
What do you mean, dude? Like, they
About
lost
crypto?
a whole bunch of members when they lost crypto.
Yeah. Back whenever there was not a lot of brokerages offering crypto. I think if you want crypto, there's places to find crypto that aren't SoFi. I don't think that'll attract members. I think that they will get cross-sell from existing members. Like, oh, you're on the platform, they offer Bitcoin. Okay, I'll just buy it here. But I don't think that's going to bring people onto the platform.
That's a fair point.
The base, like the base assumption, even without crypto, is like 800,000, whatever. It's just a new offering, right? It's just a new avenue that can get more people in. Whether it gets 50,000 members in or 100,000 members in, like, sure, that's
Or 50.
Yeah, or 50. Like, it's gonna be non-zero addition impact to members, is what I'm saying.
Yeah. Unless the crazy people are like, oh my gosh, every time a brokerage offers crypto, I leave them. You hear this with Robinhood, like, oh, they've offered event contracts now, I'm freaking leaving. I don't care if they offer the best pricing in all these areas. They offer something that I think is morally wrong.
I mean, remember that back when SoFi actually did have crypto on their platform, they actually you could DCA with every paycheck at zero fees, like literally zero fees.
That is what caused us to lose crypto.
Right. And that's what caused us to lose crypto. But I'm just saying they can do unique things. And the other thing, like crypto, because for SoFi, it's all just incremental and they don't need it in order, like they can do some creative things in order to bring people in order to make it so that like they don't need it to be a large revenue generator. They can use it as a differentiating factor though to other banks, right? Sure. I agree with you that lots of people do like people know where to go to get crypto. And if you want crypto, you've already got exposure. And I think that it'll be a great cross-selling product. But I think kind of what we're all leaning toward is like quarter after quarter, year after year, they just keep fulfilling the vision that they've had, that they set out, years ago, this one-stop shop where they start cross-selling, where he also brought up the Expensar thing, which is something I've never heard of, and Cash Coach, right? I don't know what Expensar is. Well, I guess we'll see. But it does seem like there are like, they just keep building this foundation of products and just this breadth of products that's just going to get better over time.
Yeah.
And I can't see how this doesn't just keep compounding, because they are going to be one of the winners that takes most, is basically what I'm getting out of this call and what I'm getting out of the results. If they keep compounding like this, if they keep adding offerings, they are going to lose, they'll lose some customers to Robinhood. They'll like some, and Robinhood vice versa will lose some customers to them. There's going to be other people in this space who succeed. And I think Robinhood is one of those, but I just like, compared to everybody that they're competing against, like in the note that you sent from Citizens, right? Like they are in single or like double-digit basis points. They're less than 1% of the addressable market. And compared to Schwab and JP Morgan and Citi and Wells Fargo and everybody else, like the offerings that they have are so much better and differentiated in so many ways and much more convenient that if they just take 2% of that market share, that's a 10, 20x from here.
Yeah.
So
in
someone
terms of the size of the business.
Someone in the chat said, so are we going to see analyst upgrades? I don't see how we couldn't, if you just look at their revenue and EPS expectations, they were below SoFi's guidance. And then SoFi comes out and says, okay, well, we're going to raise guidance on both top and bottom line. So not only before were we saying 25 to 27 cents, which is where Wall Street is, they're at 25 cents for this year. Now they're saying 27 to 28 cents, meaning 25 is out of the picture. Okay.
Yeah. But they did beat by 3 cents this quarter, right? So like the raise is about the same as the beat.
Right. But that's still full year.
Yeah,
so,
that's still full year. They have to go up. You're right.
Yeah. So what is Wall Street going to do? You're going to keep it at 25?
No, especially when the first quarter 6, right? Like even if they just repeated this quarter 3 more times, you're at 24.
Yeah, I mean, even just like them reiterating the loan platform business is gonna be accelerating quarter over quarter with just deals that they've announced already. Just reiterating that fact to the market, I think, is going to send a strong signal for analysts that, like, hey, our models are off because we're not accounting for this like massive thing that's growing. What did he say is like our $3 billion run rate business, something to that effect for the loan platform business.
Yeah, I think 2 is going to be SoFi Money, and then 3 the loan platform business.
Yeah, like their ability to scale to multi-billion-dollar businesses within their sub products is absolutely going to be warranting upgrades.
Did you see the contribution margin on financial services, Chris?
Yeah, it was it 49%? Yeah, that's crazy.
I wonder
that's
back,
absolutely nuts.
Like the last time that we spoke, me and you, I think we talked about contribution margin. Like, I think we were like, okay, what does this settle out at? Like 30%, 35%? Like now I'm like, okay, does this settle out at 60%? Like where does this go? This is ridiculous.
Yeah, and I mean, maybe the invest has lower contribution margin as other. It's just that the LPB has such high contribution margin compared to everything else that it's just skyrocketing because that's taking over. But yeah, I'm sorry, I got to bow out because I got to take my kids to school. But thank you guys for having me.
The excuses, man. You and the excuses. These kids of yours. I mean, no, thank you, Chris, for being here. This is really great.
Thanks, Chris.
Yeah, thanks, guys. And thanks, everyone, for tuning in. And we'll talk to you later.
I thought I'd just leave it in silence, let him do his whole sign off, keep it as awkward as possible for him.
I don't know if he understood the joke. I think he thought I was like actually giving him shit for having kids. No, Chris, please.
I was like, I'm not gonna help him out at all. He can sign off. Oh man. No, I'm excited about this. I think once again, the only thing that has let us down, I mean, the tech platform sucks that the accounts are dropping. But
the only other thing that has let us down, go ahead.
The only other thing is our own expectations. People saying, this is gonna absolutely freaking moon or whatever. I mean, after earnings, stock up between 7 to 9%. That's great earnings. These are beats. The stock's moving in the right direction. I'm a happy camper. And just like last quarter or Q3, the stock didn't do that much on actual earnings. And then over the next few months, it actually started to really run. So that's whenever it took us from $7 to 13.
I mean, I love how people were giving me crap for saying, oh, well, your $18 covered calls positions is like 90% in the profit and you can close them out for 4 cents. Like, dude, like, will I take on the risk? It's like, I've been through this rodeo in the past. I'll take a 7%. Like if it holds as soon as the market opens and throughout the day, like I'll take a 7% day. I'll take a positive day because last earnings, we reported great numbers and the stock was down 10% plus as a result of them like lowering the guidance expectation essentially and going back into growth mode and saying, hey, we're going to do 25 cents of EPS. Like the stock tanked on that news, regardless of the earnings, regardless of the loan platform business deals, whatnot. And so this time around, like, yeah, sure, I'll take 7, 5, whatever percentage it ends up being at the end of the day. But it's not going to go up, 35% to go to $18, guys.
Maybe if they partner with Novo Nordisk. So.
Yeah, Hims is up 35% today. I mean, we'll see where that shakes out, but that's a fun one. Stealing a little bit of the thunder, unfortunately, but I'm not complaining too much.
So Steve is texting me right now. He said this was a blowout quarter.
Oh.
He's very happy.
Okay.
He's going to listen to the call, though. He hasn't listened to it.
He joined for a moment, and then he, left again?
Yeah, he didn't realize when the call was. He wanted to say a few things, but yeah, he got up late.
That seems to be a trend around here.
I just want to make it known. I was on time.
Dude, you're the only full-time YouTuber amongst us all.
I don't know what that means. I'm an investor. I wouldn't call myself a full-time YouTuber.
You just investing at home all day, eating Cheetos and making videos.
I care about the companies that I invest in, and so I listen to their earnings calls on time.
You literally were clocking into your full-time job, Tanner. I'm doing this before my job starts. I got a meeting in 10 minutes.
Also, look at these fingers. I haven't had Cheeto dust on these fingers in years.
Seems like some white-collar fingers to me. No calluses or anything on those fingers.
It's true. That part is true.
On the tips of your little fingers from typing, but other than that. All right. Are we wrapping there?
Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. But bye for now.